degree in both finance and accounting.
Where did you work before Merrill?
Before Merrill, I was in a couple of different capacities. I've owned a couple of my own businesses here in town. My sweet spot is entrepreneurial. I like to help business owners, and so what I do with my clients today encompasses more than just the market. What we're going to talk a lot today is planning and how to plan so when situations like we're in right now, you don't panic and you don't get upset. You basically know that this type of time is going to happen and we want you to be prepared for it. So I'm going to use this presentation as a guideline, but I will go off a little bit into some other areas. But first of all, I'd like to thank the Manchester Library for hosting this presentation today. They're a great resource, and I know all of you probably use it in various different capacities, and I don't know where we'd be without it.
Yes.
It's definitely one of the backbones of this community. So today, we're here to talk about ways to strengthen your finances and plan for unexpected events. And this could be anything from replacing a car, making a major repair on your house, to a sudden long-term illness. And the most recent things we've dealt with were the pandemic, COVID, which brought about a lot of major illness and shutdown of the community and some people's sources of income. And then most recently, inflation. That was unexpected, across the board. And how do we plan for situations like that in the future? Let me see if I can turn that down, because we don't really need that. Okay. So today's agenda, again, we're going to evaluate the financial picture, we'll create a financial cushion to cover emergencies. We'll also review how insurance plays a role in life's changes, as well as how we can create a legacy in estate planning. And finally, we'll cover some resources that I can offer to help you pursue your overall wellness. And if you have a pen or want to take some notes, there might be some links that I will refer to. I have some packets here that you can follow along and make notes on the presentation, and I'll resort to, I think I have enough for everybody.
Okay. Thank you.
Thank you.
You should have an extra pen. He's brought one, but I didn't.
Here you go.
That's all right, I'll go upstairs.
No, I don't think I need it. I don't think I need it. If it works, it should be good. Okay. So, to get started, let's talk about your financial picture. And this is trying to balance your needs and goals. And you can look up on the screen too, whatever is more comfortable for you. So, the first step is to establish a spending plan. And that can help you find ways to make choices. So I'm on this page right here, which is page 4. So what is a spending plan? Basically, it's a simple budget, a one-page worksheet, which is in your packet on the left-hand side. See if someone can hold it up. Is it stuck in there? There it is, front and back. Okay, great. So this, hopefully you'll feel inspired to go home and fill that out. If you want, I can also send you the link to that so you can enter it interactively. It's a spreadsheet and it will add up all the columns. and it'll help you see where you are today. So basically, you're recording money coming in and money going out, and then you're going to determine what is the excess. Are you spending beyond your means, or do you have excess? Then if you have excess, then I'm going to help you with how to spend or save that excess. So I can help you control your finances and pursue your goals while navigating any financial challenges or changes in your lifetime. So if you're finding it tough to live within your means right now, budgeting can really help you. It will definitely help you, and you'll understand exactly where you're spending too much. So we're going to talk about the 50-30-20 budget guideline, and this can be a helpful tool when setting up a spending plan. So basically 50% represents your needs. These are your essential expenses: your mortgage, your utilities, your gas, your groceries. This is what you need to survive. And let's say if those of you are working in the room, or you add up all your sources of income, whether it's a pension, Social Security, interest and dividends, after tax, whatever that amount is, let's say it's $50,000, okay? That's your source of income after taxes. 50% of it, let's say $25,000, goes to your necessities. Those are your needs. Then the balance of it, that other 25%, 30% of that is going to go towards your wants. What are your wants? Your wants could be, going to the coffee shop, getting specialty coffee, buying a new dress for, an outing that weekend, going on vacation. Then the other 20% of that 50,000, which is going to represent 10,000, is going to go towards your savings, okay? And that savings can represent anything from, if you're still working, it could be your 401k plan. If you're saving for your children's education, like a 529, or you're a grandparent and you want to save for your grandchild's education, then that is going to come out of that 20%. Let's say you're saving for a vacation or a wedding. I just had my first wedding. My first child got married last Friday. One down, 4 to go. I wish I had started saving for that wedding, but you're saving for other things. So this is how we're going to think about this plan. So again, your needs, your wants, your savings. Any questions on any of that?
So can I just say one thing about that? This looks very neat, but these needs, for example, are very dependent on others, like the town tax, the change in, let's say, Medicare, a variety of things like that. Or if you have, if you're like me, you have to take a minimum distribution, and it's based on what the value of my
Your
savings
holdings
are. That's all a big, it's
unknown. It's dynamic.
It's horrible.
It is.
It really is. And suddenly you're in some tax bracket that really doesn't reflect, what you feel like are your minimum needs. And you have to pay them. They're right there. There's not something where, we'll save and then we'll pay it, but no, now.
Exactly. That's why that 50%, that 50% is a percentage. It is what it is. And it could be 60% or 70%.
Yeah.
It could be much higher. And then the balance is less that you can then spend, or it could be in some cases 100% for people. They can spend all of their paycheck on their needs. So that's why this plan is dynamic. You know, it's not one and done. You know, when I work with my clients on this, we do this once a year. We do it right in the beginning, and then every year we go back to it. And, you know, what are the changes in your life? Are you changing your career? Do you now have to stay home and take care of a loved one? Has your employment changed? You know, have you moved to an area where it's a higher cost of living? So then you have to go in and readjust that plan. And we're constantly doing that, you know. And so this budget is your start to it. I use a much more sophisticated tool at my office, but this budget is the first step. I give that and I say, fill this out, and then I'll ask you some more questions, and I'll show you what your expected cash flow will look like throughout your end of your life. But that's gonna keep changing. As Rita mentioned, you know, all of a sudden when you start taking Medicare, well, there's a lot of costs associated to that. You pay taxes on pensions, you pay taxes on Social Security. So sometimes you can be paying more taxes, and you're paying taxes on your retirement saving. Later in life, your biggest costs are going to be healthcare, and it could be taxes. So these are things that, you know, what I'm trying to help you plan for. But that is a very good point that Rita's making us think about.
So we fill out the paper form, and then at the office, they do the online form, put it online, or do we do the online?
You can do, so, look, I'm not requiring any of you to work with me. If you choose to, you can. You know, that's totally up to you. If you want to go off and do this on your own, you can access that online tool by going to ml.com/budget. But I can give you a more thorough outcome of that if you want. Once you get through that first step, I can help you, give you a more thorough plan, or even tell you what to do. You know, you might say, I did this, but there's too big a gap. What do I do next? How can I prepare, you know, for the next step? And that's when I can give you some suggestions. So when preparing a budget, you also need to think about planning for the unexpected. So today, and just like Rita said, that doesn't cover the unexpected. Some key concepts that you may want to prepare for with these curveballs like COVID and inflation is there are three main areas. We'll talk about the importance of setting up an emergency fund, and I talk about that a lot. We'll review different types of insurance, and we'll discuss how developing an estate plan can help make sure your family knows your wishes and can act on them in the event something happened to you, okay? Of course, emergencies happen when you least expect them, and so let's talk about how to be prepared. So today, roughly 56% of Americans cannot cover emergencies, $1,000 emergency expense without savings. So if you needed a new roof or surgery, some medical emergency, could you pay for it? You don't have to answer, just think in yourself. Where would you go to? Which bucket of funds would you go to if you needed $20,000 for a new roof, or a $10,000 knee operation or hip operation that wasn't covered, your insurance? Just think about where you would go to. Do most of you in this room have that emergency savings account? Some type of account? So what is an emergency savings account? Basically, it is liquid form of assets, cash, you know, your checking account, your savings account. Some people think of their HELOC, which is a home equity line of credit on the mortgage, as being their emergency fund, as long as it's something you can quickly access within a day, and not stocks. not stocks or bonds that you have to sell, that you might have to sell at a time like now. That is not an emergency fund account. So it's primarily something that is FDIC backed. You know, it's sitting in a bank, you can go and take it out. Now, how much should be in your emergency fund account? Typically, for someone who's single or a couple that has children, you want at least 6 months of your total year expenses. So if that, you know, your total year expenses that you spend on your needs and your wants is $80,000, well, you'll want $40,000 sitting in cash. What we just went through in this pandemic was a perfect example. I mean, for 6 months, everything shut down. You know, it went to a complete halt. And fortunately, the government came out with the stimulus quite quickly. And so it helped fund those people who their work just stopped. But again, many people had to resort to their emergency fund account. So that's important. So think about how it could help you. Again, it helps you avoid spending, paying credit card interest and fees. Some people think their emergency fund is their, 6 credit cards they have in their wallet. Well, right now you're paying 22% on using those credit cards, anywhere from 12 to 22%. So that is not exactly an emergency fund. It also prevents future setbacks by providing a cushion. And also it avoids you taking a loan from your 401k. If you dip into your retirement assets as emergency fund, then they're not going to be there for you later on when you need them.
And you're going to have to pay taxes on it.
And it's, right, exactly.
Unless it's a Roth, right?
Unless it's a Roth, right, and God bless you.
Thank you.
So does anybody have questions on a Roth? Do you know what a Roth is? A Roth is another type of IRA. So, and it's a way that you can contribute funds to it. It's not deductible off of your adjusted gross income. God bless you. But it grows tax-free. So as long as you don't take out that accumulation in 5 years, when you do take it out later in life, then it's tax-free. And that is great. Any way you can move your IRA assets into a Roth and you can afford to pay the taxes to do that, later on you're going to be better off. It's a timing thing, and I can talk more about it if anybody would like to. So anyway, it varies on everyone's different situation here, but aim to save to start if you don't have an emergency fund today, and those of you who are watching, start with $500 to $1,000 initially, then build that up over time. And a good rule of thumb is to try to save, like I said, 3 to 6 months of living expenses if you're single, and 6 to 9 if you're married with children and one spouse perhaps may stop working in the future. So the way you and then consider growing that over time and to use found money to grow that emergency fund. So what is found money? Found money could be gifts. It could be a bonus. It could be your tax return. So anytime you get a chunk of money that you didn't expect to get, put it in your emergency fund account. Is what I recommend. So here are some steps to consider to help you build with your emergency fund. So think about what unplanned event has happened to you or could happen to you. Was it a medical expense? Maybe your pet, you had to have surgery for one of your pets. I have a couple friends who've had to spend $8,000, $10,000 on their pet, and nobody plans for that. So be prepared for something you haven't anticipated, And this might motivate you to start that fund if you don't have it, or to keep it up. Some people may have used it during COVID and now they need to replenish it. So it can help you from unexpected expenses, but how do we protect ourselves from larger financial losses? Like an average homeowner's insurance claim is $13,582. And the average property damage claim in an automobile accident is $3,841. So most of us would cover this by insurance. If we didn't have insurance, that would put a big dent in our budget. So let's, there's other types of insurance that could be helpful as well. And, some of you are aware of these, but others may not be. So insurance can help protect against big losses such as illness, theft, property damage, and loss of income due to death or disability. With insurance, you pay periodic premiums. In exchange for those premiums, the insurance company is sharing with the risk and the loss of that. So before you run out and buy all kinds of insurance, just identify those things that will give you the greatest risk. Identify the biggest financial risks. If something, if it was your health, your house, and then carefully review the policies you have and what they actually cover. And make sure you don't have duplicate policies, because insurance can get expensive over the years. The older you get, the more expensive the insurance gets.
I thought by getting a supplemental insurance to Medicare, you're constantly getting cards or phone calls or things in the mail about that. So first I went with United Healthcare, and then they started denying things, and then they started putting time limits on, counseling and so forth. So I went with WellCare. Well, one of my doctors, my eye doctor, doesn't take WellCare. And it was all over again, It's like I went with WellCare because the guy who talked to me on the phone sounded really good. I'm not in it, I'm still getting things from WellCare, but I thought, I never had this problem with just straight Medicare and Medicaid.
But you are with the supplemental insurance. Well, you bring up a really great point. And what I was going to say next is it's really important before you lock into this insurance to make sure it covers your doctors, it covers the medications you need, and if it doesn't cover the big ticket items, then that's probably not the plan, because that's the point of that plan, is to cover what Medicare isn't covering. And if it's not going to cover it, you shouldn't pay, why pay the extra money?
The dental, they were supposed to pay the dental, and I keep getting this bill from my dentist, and I don't even go to the dentist. I go to, the hygienist cleans my teeth every 3 months because I go that often because of the fact that I have periodontal disease, so I want to keep ahead of it. And they, I keep getting a bill, and I said, send it, finally. I told her once, I told her again when I went, send it to Medicare, because I'm not paying $95 for a, thing I didn't even see the dentist. And I know that I have to pay for the cleaning, but it's crazy.
It is. So Rita can help.
One way around getting into that pickle is like you go to a certain dentist, and I always say to the person who keeps appointments, is it worth it for me, because she's got my record, to get the insurance? And she'll usually say, well, look, you're going to have to pay X, and this is how much it costs to come here. you probably don't eat it. That's one thing. And the other one that was kind of shocking to me is that it looks to me, and this is not for sure, that in Vermont, Blue Cross is the best thing to have because it seems to be widespread. Whereas I have United Healthcare, and I'm not changing it because I've been doing business with them a long time. But many things are covered by Blue Cross that are not
But it's
covered
expensive.
by United Health. You know?
Yeah, and I can't afford it.
Well, so that's, you can ask a doctor a question like that, like, I know you take United Health, but, you know, do you think that Blue Cross is a better benefit for me? They probably won't tell you because that would be a conflict of some sort. But that's the other thing, is to ask. Don't be afraid to ask.
No, I'm not.
Yes.
Something you need to be sure when you're looking at your new Advantage plans, check them out carefully.
Mm,
Oh, those, that's terrible.
yeah, it is.
Yeah.
But one thing about an Advantage plan is there's a maximum out of pocket that you pay, I believe. Whereas if you're just on Medicare,
And Medicaid.
there's no limit.
Right.
You know, if it's, there's no limit.
Right.
So that's where they come in, I think.
So maybe what I'll try to do for my next presentation is bring along a partner who has the expertise in those healthcare plans and could possibly give some advice. And that's an area that's dynamic and always changing with regulation and, you know, so it's a hot topic. And so also, for those working, always check with your employer about different benefits that are covered and any type of insurance that they offer. Because within group plans that you can get insurance through your employer, it's typically less. The coverage is going to cost you less. But if you leave that company, you'll have to get new independent.
Especially if your husband passes away in 30 days, you don't have any insurance.
Well,
Well, the other
they
thing
co-broke.
about using a company's insurance plan is that if you have an issue about something, you can go to the what does the HR signify?
Human resource?
The human resource people and say, look, I've got to do this and the policy that I have with you says no. Am I asking the right questions? Did I not do it in the right thing? Help me. And they usually, well, they know everything about that plan because they're working with those people.
You know, I have worked since I was probably 17 years old. And I've never worked long enough with anyone that I had anything,
Yeah.
coverage for anything, or 401k. I never have. And I've never made probably more than $10 an hour. And I'm 80 years old, and I worked since I was 17.
That's
The other thing
unfortunate.
for us
It's changed a lot now.
us guys, the VA is another outlet for us,
Yeah,
for
sure.
both benefits, for
Yeah.
myself and for our
Your
wives or
families.
spouses.
You're very
Yes.
lucky.
Yes.
VA.
There are a lot of different resources out there. So looking up on the screen here, there's a lot of different insurance. I'm not going to go into them all. The one I'm going to point out is umbrella policies. And sometimes it's called excess liability insurance, and it provides additional liability coverage for injuries to others beyond what your typical homeowners or auto coverage will carry. And it could also pay for any legal defense if you were getting sued, if you had a dog, somebody, and they bit your neighbor and they were suing you, an umbrella policy would cover for your legal defense. When you do, and it's relatively inexpensive, and most good insurance brokers, agents will recommend it. when you do go, make sure if you have, let's say your total net worth, and that's where I help people, is $3 million. Let's say your house is 500,000 and you have personal assets of another 500 and you have a $2 million in investable assets. Make sure your umbrella policy covers your total net worth. If somebody was to sue you, they'd go after all your investments.
Is that very expensive insurance?
No, it's like, it might add another 150, my policy, it's not that much, like 150, not a lot of money.
Per year, you're saying?
Yes, that incremental amount is definitely worth it. So if,
Excuse me, question, is that like a supplemental to your regular policies?
Yes.
It's not a standalone policy?
no, you cannot get a standalone, you cannot get an umbrella policy without having auto insurance and home insurance.
Okay.
So if you don't have that, they typically won't write your umbrella policy.
So would you get it from the
Yes.
company from whom you're getting the
Your
house?
homeowner.
Is that really?
Yes, you would get it with your homeowner's insurance. Typically, it's on your homeowner's insurance. But now a lot of insurance agencies are trying to get you to bundle both your auto and home together.
Yeah.
For that reason, that a lot kind of overlaps and there's some gray areas. And the umbrella policy kicks in, based on that coverage. I don't know why this is so bad. Down.
So as a financial advisor, would you be going over these items and making recommendations to people?
What I would do as a financial advisor, I would offer to look at any of their policies and explain to them what they have. So what I do for my clients is I say, bring in all your statements, all your investment statements, all your insurance statements. They say, oh, I have life insurance. Okay, bring it in. I haven't done a statement in 3 years. Well, then you don't have the policy because they would be sending you a bill every year. So that's why I say bring in all your statements and I will explain to you what coverage you have. And if I feel like there's a gap that you should go back and get more coverage or two plans are overlapping, then I will suggest that.
Okay.
I will tell them what to ask and go back to their insurance. I have my insurance license and I do help clients sell policies for term, long-term, permanent, long-term care. But in most cases, the value I add is by reviewing their existing policies and explaining to them what they have, because most people, they may have bought the policy 30 years ago and have forgotten about it. So what would happen to you and your family if you were injured and you couldn't work? I know many of you are retired in here, but you may have family members who's in that situation. Disability insurance can help cover that gap since it replaces your earned income. And most employers offer disability insurance. And it's important because it may cover those 2 years before actually Social Security disability insurance may kick in if you were able to get that. Keep in mind also, disability insurance only covers you if you're working. So if you pay for that and then you stop working, it doesn't cover you. After, let's say you've retired, you haven't been working for 6 months, and you get injured. Well, that policy is lapsed. Once you stop working, they're no longer going to pay you disability if you're not working.
Even if you have something that is, what do you call it, I have osteoporosis.
If that policy already kicked in, I don't know what your policy is. That's not the general statement I'm making is if you have a disability policy based on you being employed, it stops it. If you have a policy based on an illness that you have and it's covering you, then it's going to continue to cover you. It is probably the case. I'm just making a general statement as far as
That's self-employment. Self-employed can get disability insurance.
Yes, and if you're self-employed, you'll want a private disability insurance, and make sure you understand what it does cover, and, you know, based on what other employment you can actually do and still get paid on. So, let's talk a little bit about life insurance, because it can be very beneficial. It may help you provide financial security for your family in the event of your death. If you had lost a spouse and they had life insurance policy, it would give you immediate funds to provide for any medical or funeral expenses, and especially to help with any estate taxes. And typically, life insurance provides an income tax-free death benefit to the named beneficiary. So you do not have to pay taxes on that when the insured dies. But only about half, based on our study, half the people in the United States are covered by some type of life insurance. So life insurance can also be helpful for estate planning purposes, such as paying estate taxes as well. So when you, and I do this analysis for clients too, to help them, especially younger people, determine what type of insurance should you get. There's basically two types of insurance, term and permanent. And term life insurance provides a death benefit protection for a specific time period, typically from 10 to 30 years. And it only pays a death benefit if you die during that covered time, okay? And the benefit of term is also they're less costly. It's less expensive to get term. And the reasons why some people would get term, okay, so a young couple, they buy a house, they're having kids. One of them is, you know, a stronger breadwinner. They might both have policies for a certain term. Let's say they have a 20-year mortgage on their house. They'll definitely want a 20-year term to cover. And let's say their kids are 3 and 5, they'll want to at least cover until those children have graduated from college. So we go through an analysis, determine what value their policy should be to cover paying their, you know, to cover that income they would lose over that time period that they're gone. So it would cover the lost income, the payments for the mortgage, and any college expenses. And that's what I go through and try to understand what assets they have in place, you know, if they were expected to pay for college, and then help them with that type of policy. The benefit of a permanent life insurance, it provides lifetime protection as long as the premiums are paid. And this may have a fixed level of premiums throughout the life of the policy. Or the policy could have a cash value, which part of the premium goes into like a savings account, which is called cash value. And that it could cover future premiums if, let's say, they lost their job. It also allows, that cash value also allows, in permanent life insurance, it allows for the owner to borrow against that as a loan. They can take a loan out of it. Let's say they've been saving for this and putting money into the cash value. They can use that money to pay for college. They can use that money for a down payment on a house. If they choose, they can pay it back, and it continues to grow, and it'll be part of that death benefit. Or if they don't pay it back, it just reduces the death benefit. So there's a lot of value to having a permanent life insurance policy for some of these younger people during their high income earning years, because it forces you to save, and you typically won't spend that amount on a new car or Yes.
Now, if you only pay for like 20 years, I have a policy that I only have to pay for 20 years, and I'm still covered after the 20 years. Is that
Yes.
the same thing?
That is another type of permanent policy.
Okay, so. it's
That
not-
you've paid higher premiums up to those 20 years.
Right.
And so you want to understand that type of policy, you know, what that's going to cover long-term. And so there's different types of policies that will, you know, either have flexible premiums, fixed premiums. And then also give you the ability, some term policies you can then convert to a permanent policy. You know, there's a lot involved here. I could have a whole discussion just on life insurance policies, and I, you know, have that conversation quite frequently. So if you want to talk about that, I'm happy to do it at another time. I just want to kind of give you the overview of it, but happy to answer any other questions on that now, if anybody has a specific question. Well, another important component to healthcare planning is long-term care. Nursing home care, well, first off, with our health system today, everyone's living longer. I mean, I know 5 friends who have mothers, not fathers, mothers, that are 98 years old.
My mother lived till she was 104.
That is
Wow.
amazing. My grandmother lived to 98. So that is tremendous, and many of them are having great quality lives. So what you have to do is plan that you're going to live to your 90s. And that's incorporated in the bigger plan that I put together, is to show them how much money they're going to have in their 90s. And then we factor in what it's going to cost for health care. An average couple is going to spend about $350,000 on health care throughout their life. It might be all in for one of them, it could be divided for 2 of them, you know, maybe nobody spends that amount, but that's the average cost. So within a plan today, we really have to budget what those costs are, and long-term care can help that. Medicare only covers a small portion of short-term rehab costs. It doesn't cover long-term care, and Medicaid might pay for long-term care, but you first have to spend down all your assets. You have to have nothing left
Right.
in order to get Medicaid. So don't count on Medicaid to pay for your long-term care.
Well, you wouldn't have nothing left. You would
Well,
be low enough so that you don't have to pay taxes, which,
yeah,
whatever.
You may have to get rid
It's-
of your house, maybe.
it's pretty
I
low.
don't think you can own a home
No, no,
and get
no.
long-term.
no, you can't. No, I'm saying, so if you fill out a tax form and you've got $20,000, okay, that's fine for Medicaid.
Yeah,
Okay.
Medicaid is very, very low
That's what
income.
I'm saying.
But you can have very low income and have a nice house, you know? So you have to be careful.
Your house is your asset.
House, right, you have to be careful. So my point is, don't count on it. You know, really don't count on Medicaid to.
Isn't long-term care insurance awful expensive?
Well, reality is, long-term care, most people don't fit into that category of getting long-term care. It's kind of the middle group that really has enough money to go out and afford it, and it provides some value. So what I do with clients is I go through the analysis of, because there's a whole different scenario. Some people want to live with their family and you know, have them help them. Some people don't have any family to help them. Other people, you know, want to purchase long-term care so they don't burden their family. There's a lot of different reasons why long-term care makes sense and it doesn't make sense. And so to go through that, I'm not here to sell long-term care insurance. I'm just telling you that whether you self-fund it or your policy covers it, some life insurance policies have a trigger that will cover some portion of long-term care. But for long-term care to kick in these actual long-term care policies, you have to meet certain criteria, and that criteria is hard to meet unless you're, have Alzheimer's or cognitive disabilities. It's not easy to meet that criteria and still need it. There's a lot of people who need it but don't meet that criteria. So that's a topic I can dive into if anybody has any specific questions.
Well,
Or
veterans get it. If you've been in your service,
Yeah,
you've got long-term care.
that's right.
right, you do have access to some long-term care on your policy. And you should, the point is you should understand what that is. You should figure out what you would want for long-term care. Like, how do you want to be cared for? Do you want to be in a home? And I recommend a lot of my clients start looking at different facilities. Look at assisted living. Is that someplace you want to be? You know, have the conversation with your children. You know, if they want you to be close to the grandchildren, maybe, you know, you'll be above the garage or in the, you know, guest bedroom somewhere. But knowing this well before you actually need to do that is planning. And then knowing what that cost is. So if you want to go into an assisted living facility, then you know maybe that selling your home will fund that cost. On average today, assisted living facilities, you know, in Vermont are anywhere from, I'd say on average, 10 to 12,000 a month. They're higher and they're lower, but expect about, you know, 120 to 140,000 a year to be in an assisted living. It could be less, it could be more if you need more care. But so what I do in the plan when working with my clients, I will factor in, you know, it's on average 4 years that you'll actually be in a long-term care facility. What does that cost? And factor that right into a budget. So we're budgeting for long-term care. Where the insurance comes in, long-term care insurance really comes in, is if you have extra money and you don't want to burden people and you want to not depend on other people and you want to make sure that that money doesn't get spent for other things and it's there specifically for your long-term care. Today they have some great hybrid policies that if you don't use it, then it goes to the death benefit. So everything you put into it will still pass on to somebody else, but it's there if you need it. There are other policies that if you never use it, you lose it. So it's a really lengthier type of conversation to determine whether you actually need it or not.
Can that money be transferred for a period of time before the government grabs it? Like if you transfer it now and 5 years from now you need it and you don't have it, the government would...
I think you're talking about something else. I think you're referring to spending down your assets to be eligible for actual Medicaid. That's a different scenario.
Okay.
And I would say, live your life. If you have a plan that is budgeting you to what matters most, then you're not gonna have to do that. So, I think that's...
I would just say that my husband has a long-term care policy, which he got 40 years ago. And they don't, I'm very unhappy about what long-term care means. I think the insurance company really has you by the throat, because when it comes to the point, well, for example, we had a case where he did use some of his long-term care because he had an accident, and it's very important to be leaving from a hospital to get them to listen to you. And so that started a process where for a month or two he needed the provisions of long-term care, and during that time he didn't have to pay his premium. But the minute he didn't, he suddenly owed them $700,000. And, yeah, I mean, it's called Gen X. I wouldn't deal with them. I simply wouldn't.
So here's the
I think
thing,
you need a lawyer if you're going to get long-term care. I really do. I think they need to look at
it
the
is
policy.
complex. Here's the thing, with long-term care, make sure you understand what you have and share that policy with your loved ones. Because by time you need it to kick in, you're not gonna be in a position or even recall what you have. So if you choose to get a policy, and there's some really great insurance agencies out there, you have to ask the questions, and really understand what you have, and then share that information with your loved ones, so they know that they can access that, that policy and when they can access it. Because all of a sudden, if you're had a stroke and, there are certain things you can and cannot do, the last thing someone's thinking about is that policy. They don't even remember you have a policy, and they're taking time off to work to take care of you and run. And if they know that you have that policy and what it covers, or even a vagueness of it, you can pull it out and call the company and access it. So, I mean, there's a lot of good stories with the ones that are not so good. So I think just trying to do as much upfront information as possible. So the bottom line is to try to manage your risk and share the risk with insurance company, and it can definitely benefit you in the end. So tying it all together, here's some steps to consider to help you decide what insurance coverage you may need. First, identify your largest financial risk. See where you may need insurance and what type, whether it's life, renters, homeowners, umbrella policy, disability. And then within each type, consider the differences, term or permanent, what fits your needs, what fits your budgets, and then understand the options. Can you upgrade to a different type of policy? If you don't need it, can you get out of it? Any limitations or duplications of coverage. Also, for long-term care, whether it's in-home health or in a nursing home, figure out what the options are and what they cost. And most importantly, don't forget to update your beneficiary information on all your policies. Too often, you have someone, whether your spouse or a child, someone as a beneficiary and they're no longer alive, then it has to go through probate. There's a lot of problems with that if you don't have updated beneficiaries. So that's something you want to review annually.
Is that the only reason why you'd update if somebody died?
No, if you're divorced, if you get divorced, if someone let's say you've put a beneficiary and they get a great inheritance and don't need the money and you want to give it to somebody else who does. There's a lot of reasons why you would change a beneficiary, but just reviewing it every year is a good thing. So it's not only important to plan for your own future, you need to think about long-term needs of your loved ones as well. According to a Merrill study, only 18% of those 55 and older have the essential recommended will, healthcare directive, durable power of attorney. So this is where an estate plan comes into play. Something happens to you, you want to make sure all the important papers are intact, and your family knows where they are so they can act on your wishes. So let's talk about what some of those important documents are. And this is not only so they pass to who you wish, but it's there to cover your remaining expenses. So an estate plan helps ensure that your assets might include savings and investments for your home or property, if you're passing them on to others. and according to your wishes. It includes a financial strategy that incorporates investments, bank accounts, retirement accounts, life insurance policies, your wills, trusts, any legal documents required by the state law, and any type of tax planning and beneficiary planning. Remember that legacy planning is for everyone. Having your affairs in order may relieve the burden for your loved ones. Preparation can cover medical plans, medical costs, funeral arrangements, and the distribution of personal possessions. Being prepared gives you the peace of mind of knowing what you've done can organize your life and shape your legacy and leave your family with a roadmap of your preferences. Now, what is important, and I help people with a lot, is actual titling of their accounts and properties that may prevent it from going through probate, meaning transfer on death, payable on death. If you have those set up on your non-retirement accounts, then it stays out of probate and just transfers to your children, your spouse, your loved ones. Any retirement accounts are going to be left to a beneficiary and stay out of probate. But non-retirement accounts, a savings account, a checking account, an investment account, you can set up the documentation so with a phone call, it gets forwarded to the person that you've chosen. It's really can help you a lot. And then that person can help take care of the medical expenses, any payments on your mortgage, any your funeral expenses.
What's the other thing that's not a will that, I can't remember the term, where you specify, like you were saying, about all your belongings, where they're gonna go when you die, to whom?
Could be a trust. So let's go over, there are two key documents to consider in an estate plan, a will and a living trust, okay?
That's what it was.
Okay, so both have advantages and disadvantages to consider. A will only applies to one person. Both the husband and wife need their own separate will, okay? You can't have a joint will. It's not written jointly. A will lets you name guardians for dependent children in the event of your death. It also lets you provide for the distribution of your assets following your death and applies to assets where beneficiary designations don't apply. But it doesn't make provisions for any issues while you're alive, such as physical or mental incapacity. And it's subject to probate proceedings. A will goes through probate, okay?
Not always, do they?
Well, it depends if you have a pour-over will into a trust. It depends on the state. I'm not acting here in a legal capacity. I'm just trying to describe the different documents that you should know about.
I thought if you had a trust, you don't have to, it won't go before probate. That's what I was told.
Well,
Multiple
a trust is,
We'll have on the next page.
yes,
a living
we'll
trust.
get, yeah, we're getting, and this is again a very broad area. So my first recommendation to you here is go to an attorney.
That's right.
Get them to help you write a will. Have them, explain to them what your wishes are, and they will determine whether you need a trust or if a will is adequate. Where I come in with my clients is either, before they go to their attorney or helping them put together the document that they need for their attorney as far as what their total net worth is and what their investments are. And that helps the attorney determine what type of trust they may need to, minimize taxes or transfer their wealth in the manner in which they want to. So I work as to help coordinate them with their attorney to make sure their wishes are met. And then once their attorney helps them with the will and the trust, then I make sure their assets are titled adequately so, those wishes are met in the name of the trust. So within a trust, there could be real estate named in that trust, there can be investments named in that trust. There's a lot of different vehicles and purposes. So I'm not here to really tell you which is best, just explain why there's a living trust while you're alive, and then it can become irrevocable upon your death. So while you're alive, like I said, a will does nothing for you. But a will is subject to probate proceedings, court supervised process that identifies and gathers your assets. Usually a personal representative who acts as your executor needs to probate your will. It also may be contestable, so consult your legal advisor whether that option may be appropriate for you. So a revocable living trust lets you transfer your property to the trust during your lifetime and offers benefits while you're still alive. It may also contain post-death provisions. A revocable trust can assist in managing your assets if you're incapacitated. You can name a successor trustee or trustees to assume responsibility of the trust if you become incapacitated or die. This is a binding document and usually has a no contest clause, and a trust could be expensive to set up. So you really want to determine whether you need a trust. That goes back to my point, depending on what assets you have and how you're leaving them. You could potentially have everything titled in a way that, the will and trust may not even be important, is what I'm saying. It depends on the assets you have and how you prepare for it, that whether a trust is really necessary. So you have to be careful. You really do your homework, talk to your accountant, talk to your attorney, talk to your family members. Figure it out before you just go to a lawyer and say, I need a trust, because they're going to say, okay, you need a trust, I'll create a trust and give you a trust. You say, I need a will, they're going to create a will and give you a will. Where, your other advisors, like myself or your accountant, will be helpful is to explaining the options of whether you actually do need one. I go through the scenario of what matters to you and, try to do some of the front work. So then when you go to your attorney and he asks you questions, you're very comfortable on what you want at that point. You know why you want it, and you can answer their questions, more confidently. So, moving on, other important estate planning documents include a durable power of attorney. This and everyone should have one. This is an easy document to put in place. It lets you designate someone who can make financial and other asset or legacy-related decisions on your behalf during your lifetime, including during periods when you may be incapacitated. A lot of people during COVID were put on ventilators. You needed a power of attorney before you went on that ventilator. You may not have come off it. So it's, you don't want to be filling out a durable power of attorney when you're in the hospital. This is something you can do beforehand and make sure that your loved ones know who is in charge if you've assigned them as your durable power of attorney.
Now, there's one of those for finances and health, correct?
So you can have a general, typically yes, you can have a general overall power of attorney. Most financial most financial institutions will do their own power of attorney based on your financial situation. Somebody coming in and making decisions on your behalf based on your investment plans. Then there's somebody who's making the healthcare directive, the person who's making decisions based on your health.
Two different things.
Yeah, they're two different things, you know, and again, they're only active while you're alive. Upon your passing, they're done. That person is no longer able to act on your behalf. So a healthcare proxy, this document lets you designate another person who can make health decisions on your behalf if you become incapacitated. The Advanced Healthcare Directive is known as a living will, different than a living trust. This document specifies your end-of-life preferences. And this is important, like what is quality of life? You know, is being on a feeding tube, you know, for how long? If you are in a room and you can see your grandchildren, but you can't talk to them and hear them, is that quality of life? You know, what is quality of life for you? Make sure your family understands what that means to you and for a length of time, and, you know, just have that conversation more than once.
You can change that at any time.
You can change it. You can change it. So you can put it in place now, and then you can change it again when you're, you know, on your deathbed if you want. So you can definitely, but at that point, that's the last thing on your mind, is thinking of changing it when you know, when you need it to be changed. So think about that. Then there's the HIPAA authorization and release. This document lets you designate someone who can have access to your medical records when needed. Again, keep these papers organized in a safe place and updated so others can find them. And I do have, I didn't bring it, it's a 45-page document. I can send you the link to get it online, but it's a family organizer. And it asks you every question from, you know, every bit of paperwork, every account you need, who your doctor is, where you keep, you know, where your septic tank is, where, you know, all this information that a loved one would need to know, you know, that maybe you just haven't put on paper. So it's a great document. You know, if anybody wants me to email it to you, I'm happy to do that. Just drop me a note or put your email on the sheet, and I'll be happy to do it. So, again, let's see. Again, the beneficiary, naming a beneficiary is important. If you can name a beneficiary, again, on retirement accounts and life insurance policies and some bank accounts. And again, that will just transfer over. You can also name different beneficiaries. You can name, you know, as many people as you want. I have 5 kids. I'll probably, you know, it'll be 20% each kid on most of my items. You can have contingent beneficiaries. Let's say if someone was to pass away, if you do a contingent beneficiary, then if that person passes, then it's going to fall back to the other person.
Want to do that naturally?
You'll have the option to do it, but a lot of people haven't done it. Like, I would go back and look at your, you know, go to your advisor, go to your accounts, say, do you have a contingent beneficiary form? Do I have contingent beneficiaries set up?
So it states that on some of your accounts.
Yes. Or they may not have had it, you know, 10 years ago and they have it now. So it's a good question. It's a good question to ask.
Could I just say something that I think I know, but I don't know well enough? There is something about some of your assets where there's a federal thing called ERISA, which is that half of that, it's a spousal thing. Your spouse will have the result, whatever's left in your estate. However, there are ways for that not to happen. You know, you might want to divide up certain things, right? But this federal law is called ERISA, and it's very serious. So I think it's something to really talk to an attorney about.
Well, okay, what Rita's is talking about is your spouse and many retirement and retirement accounts. If there's no beneficiary, it defaults to your spouse. And you have to put your spouse. If you choose not to put your spouse, then they have to sign a form. There is a form they can sign saying they will refuse it.
Yeah.
But there are a lot of pensions and retirement accounts. If you are married, legally married, it will default to your spouse. Okay, so again, keep your beneficiary information. Good point, Rita. It was in my next paragraph. So I'm glad you reminded me. So update your beneficiary information and consider keeping copies of your designations and at home on file. A lot of people just fill it out and they forget about it. But it's important to review that and have access to it. So here's some things to consider. First, think about your estate plan. Think of how your assets will be transferred to others in the event of your death. Do you have a will? Have you named your beneficiaries? A lot of people don't like to think about this. They don't like to think about death. They put it off. I'm not going to die. If you have minor children, have you provided for their care? Talk to your children if you have grandchildren. If you're incapacitated, who will make decisions on your behalf? Have you prepared the necessary legal documents, like the durable power of attorney, or a living will, or a healthcare proxy? Those are all critical documents. If you don't have them, I would go home and think about getting them implemented before the end of the year. Like, set yourself a goal.
I handed them to my children after my husband died. They still haven't done it.
Oh, they still have, oh.
What was that? After my husband died, because we'd just been through this, I handed those documents to my children, 2 kids. Oh, we'll do it right away. They haven't done it. And that was 12 years ago.
Yeah, the kids don't think they, right. And then definitely consider meeting with an estate planning professional. You know, I can help you with the initial part of that, but then you're gonna wanna go to an estate planning attorney if you really wanna implement it beyond what the basics. So although unexpected events have the potential to derail even the best laid out plans, there are steps you can take to help prepare for them. And the first step is to evaluate your current financial picture. If you haven't already done so, create a budget and a spending plan to know, where you are in that. If you don't have an emergency fund, start one, and check all your insurance coverage. A good time to do these is every quarter you get statements, and then year end you get even more statements. So at the first week of January, just get all that mail that comes in, put it in an important envelope, and sit down and review it. And I'm happy to help any of you with explaining what you have and asking you questions of what you want and what you need, and to move you forward to the next step if you'd like that help. And again, the Family Life Organizer, it'll remind you of things you maybe didn't think about. I'm happy to send that to you. What questions do you have, or what feedback can you give me as far as another presentation digging a little bit deeper? Or maybe you want to talk about the market a little bit. Right now, what we're going through to control inflation, if you have questions about any of that, the market is down for a very good reason. So the key now is being patient, being disciplined, and being diversified. And, you know, rebalancing, and if you don't understand or you're uncomfortable, you should definitely seek out help. And I'm, you know, locally here in town, very accessible, and my card is in there, but right now, I'm happy to answer any questions.
I got a question. What do you call it? Total retirement age, I forget what you call
Full retirement
it.
age,
And I can earn as much as I want and still get Social Security.
okay,
But our tax preparer told us that my wife isn't, she's not full retirement age yet. He said that if we make over 52,000 a year, 50% of that will go to taxes.
No,
Is
it's
that
taxable.
well, what,
50% of the income is taxable?
There's a schedule for part of your income will be taxable, yes.
so what, you're looking at your adjusted gross income together if you're filing jointly.
Which we
And,
do.
right, and so your tax preparer, you get taxed, even though you're full retirement age, you're gonna get taxed on that adjustable gross income. Just because you're retired doesn't mean your taxes are any less. It's gonna be based on your total income that's generated from multiple ways, whether it's, I don't know if you get a pension, you know, your Social Security, her earnings. So what he said is correct, you're gonna get taxed on it. But what's your follow-up question?
No, but he told us we'd be paying 50% tax, but you said, I don't know, that you'd be taxed on 50% of your adjusted gross income, is that
There
what
is
you
a
said?
schedule for Social Security, okay? On that schedule, I can't remember, I think there's 20 questions, I should know it by heart. You follow that form all the way down, you come to a bottom figure, that's the number of dollars of your Social Security, the two of you, that you will pay income taxes on. It's a separate schedule to figure it out.
Yeah, I think you probably need to go back to him and say, explain it to me thorough, because, you know, he's,
Show me,
he,
show me,
yeah.
Yeah.
show me.
It doesn't seem right.
No,
I mean, it's not over, he's answering your question, but it's, you're not you know, you're not really understanding what he's referring to. So I would go back to him and say, or what's your real question, I guess, is that you feel like you're paying too much in taxes, or,
Well, if we
You'd like
have
to
to pay
avoid it if you could.
50%, oh yeah, for sure. I mean, she's self-employed, so nobody takes out for Social Security for her.
pay
so she has to pay, she's paying more for the income, yeah. I would,
Well, wait a minute, will you be eligible for Social Security when you, just because of your age, even though you haven't contributed to it? I don't know the answer to that.
I can help you offline. I think this is, it's gonna, I'm gonna have to ask more specific questions.
When you're eligible for Social, let's say, I don't know what it is, 65, 67, when you are 67 and you haven't put money into Social Security, will
Okay,
you be
great,
eligible
I'll
for
do that.
Social
Would you
Security?
just
Well,
write
she's
your,
eligible.
yes.
your name,
so-
your first and last
so,
name on that?
um,
I don't have the pen.
At that
I
time,
just
then
get
you
my pen to
will
him.
have to
Thanks.
pay, we pay taxes on our Social Security, period, right?
Right.
We pay taxes on even some of what's in Medicare, where, in the sense that you still have to pay Medicare payments. Even though you're getting Medicare, you're back where you started from as an employee when you were paying for Medicare, for medical things. Okay,
Okay.
so
Okay,
it is very complicated.
Thank you, thanks for
And what I
coming.
think your
Take your packet
insurance
back.
person or your tax person is trying to say is that don't think that it's, that the money that you're getting from Social Security is not taxed, it is taxed. Plus, it adds to your income. So when it comes to that part on the taxes, it gets added in to, you know, let's just say your income is 50, because you used that 50,000. Then let's just say your Social Security is a certain amount. That's gonna get to add it, so
Oh, yeah.
that means your percentage that you owe the federal government will increase, right? Depending, if it changes your tax bracket, is what I'm saying.
Mhm.
That may be what he meant.
Isn't the, like, 12% tax bracket go up to like 8,000?
You know what, I
No.
can't, I can't answer any tax questions right now, but I can sit with you offline and talk to you about it and help you with what questions you should go back and ask your accountant. That's probably the best thing I can help you with, to help you understand that. So you can, that's all part of your plan. And in the plan that I put together, it shows you what you can expect to pay in taxes over the years, because it typically will go up, depending on, you know, as you take higher, the older you get, you're gonna have to take a greater RMD, because it's factored on your life. So as you get into your 70s and 80s and 90s, you may have to pay a lot of taxes on your retirement assets. And knowing what that is now can help you plan to make sure you don't outlive your money, and your money is there for you. Does that make